A very warm welcome to our viewers at VCWorld, which is the venture capital community of BW Business World. We have with us today Nandini Mansinghka, the CEO and co-founder of Mumbai Angels, which is one of the foremost angel investment networks of the country with more than 190 portfolio companies. Over the last 16 years, Mumbai Angels has built a 650 plus investor base and has made more than 100 successful exits. Prior to starting Mumbai Angels, Nandini Mansinghka has been the Vice President of the Investment Banking Research Group at JP Morgan, and thereafter also the founder of the influencer marketing platform DG Booster. So you started the operations of Mumbai Angels in 2006. So could you tell us what urged you to start Mumbai Angels and how did your prior work experience at JP Morgan, at DigiBooster and other places contribute to your decision of starting out with Mumbai Angels?
So Mumbai Angels actually was started by two of my very good friends, Sasha Mechandani and Prashant Choksi in 2006. I came in as a third co-founder and the operating partner in 2017. So there was a 10-year, build-up of the company before I came in. Now, Mumbai Angels was started at a time when angel investing was barely understood in the country. It had taken shape in the Silicon Valley and it had started showing some shoots in, say, China and other parts of the world. At that time, India was, angel investing basically meant a group of friends coming together and trying to look at startups and saying, can we invest in it? Right? And that's the way that, even our network was, or the platform was for say 10 years. When I came in 2017 is when we decided that this now needs to be built up as a formidable force in what is, what could be looked at in saying deal by deal investing. So, because we are featuring here as a part of the VC platform, I think it's important to understand the difference between how we do investing versus how a VC does investing. And that's the genesis of what Mumbai Angels does, right? Now, what happens is that when startups are getting funded, they have a period of time when institutional money like VC funds or private equity would not want to come in. That's the time when two types of investors come in. One is individual investors. These are ultra HNIs who are looking to deploy a certain amount of their money in investments. And the second are family offices. By family offices, what do you mean? You mean family offices of promoters of large companies themselves. So anybody who's looking to deploy large amount of money in this asset class. Now, the difference between how you invest via our platform and, say, a VC fund is here the investor takes their individual call. So imagine us as a fund doing everything except taking the call on behalf of the investors. So cut to today where we are, Mumbai Angels is actually, we don't no longer call ourselves an angel investing platform because that is actually a dated term. It's I would say about 5-7 years old term. Today, we are what you call the private investment marketplace. So what happens over here is that here individual investors are deciding on investments deal by deal. So they will look at, say, 10 companies and they'll say, I want to invest in only one of them. And people take their own calls. So that is Mumbai Angels. I think the other part of question that you had was about me. And Anisha, it's been like quite a journey, as you can imagine. I started out on my own in 2010, actually. So it's almost 12 years now. And my earlier stints of about 12 years or so in both investment banking, and I was also a part of, the strategy group and in the internet group of Times. So I've seen, new ventures being built and bought and sold from both the builder side and the buyer side, right? Because JP Morgan allowed me to look at it from an investment perspective. I was there a telecom media technology banker. And of course, I have been in the telecom media sector. When I started out on my journey, I started doing two things. One is I started investing in startups on my own. And the second is I started building these ventures. So I've actually built two ventures, both of which have failed in the media space. So I've done, something called Idea Booster, which was primarily to try and fund films and content. So I tried doing that. I realized I was too early in the market. And then, of course, I did this digital influencer marketplace called DigiBooster. It's during these journeys of mine that I realized that I had a deep love and understanding of, what is called early stage venture investing, which is what is Mumbai Angels today. And the second is my primary expertise and, the place where I think I can add particular value in how things are being built in the Indian ecosystem is in being able to democratize investments. How can you take a large piece that requires investment and break it up into smaller parts and get more people to invest in it, which is what we are building out of in Mumbai Angels.
So post the pandemic, as we know, the amount of venture capital investments in India has made a historic record. What do you think has really augmented this growth, and why are we finding this recent cash inflow in the country? Can you talk to us a little bit about that?
Absolutely. So, see, when the pandemic started, we were as worried as any other industry. I'm talking beginning of 2020, and I actually thought that we're going to see a huge downsizing of my team and, a drying up of our investments. And we were pleasantly surprised within a month's time. So I'm talking, from March end to April end. In a month, I saw that actually there was a reversal of trend. So what was happening at our end? So first I will talk about what happened at Mumbai Angels during that period. Then, what is actually driving this. We actually saw more investors signing up during that period than we had ever done. There was this trend of the listed equity space tanking. And as it would tank, more investors would sign up with us and they would cut larger checks with us. So 2020-21 was our best year ever, in the last, 12, 13 years, right? Till the last 21-22 came, where we actually did 3 times more investing than we did in 2020. So just to give you a perspective, in 2020, we invested about 36 crores in about 35 companies. Okay. This year, we have closed the year by investing 100 crores in about 50 companies. So and this jump is in a 12-month period. Now, as you're rightly saying, you will, if you speak to any of my colleagues in the VC space, private equity space, anything which is in the venture space, everybody has seen this growth. What is happening here, Anisha, is that, we are now in a long-term upcycle in India as an economy. That's say where China was about 10, 15 years back, or the US was about 30 years back. So what I want to highlight over here is that this is not a blip. So, anybody who is getting into a fear mongering or in a fear psychosis of saying, oh, this is, we are it's a boom bust cycle and we are going to see a boom bust. Now, there might be short-term busts that you will see where, there'll be drying up of deal flow, etc. But for the next 10 to 15 years, you're going to see India create a lot more valuable companies every month than we have done in the previous last years. So, I, of course, dislike this counting of unicorns that happens because I think it is, it's more headline grabbing than actually trying to create what we are doing as an ecosystem. But if today we are celebrating about 90 to 100 unicorns that are there in India, I think we are talking of about 1,000 unicorns in the next couple of years. That's number one. The second piece is that if you are looking at a 10 trillion economy being built over the next few years, my bet is that 5 trillion of that will be built by companies that are not even born today. That is the growth that we are sitting at. And that is what we are seeing in the entire life cycle of investing in ventures. At the very early stage where we operate, in the middle stage, where say a couple of $1 million are being invested in, private equity where, it goes into hundreds and millions of dollars, and of course in the listed space. What has just started happening is that founders have become more mature, business models have become more mature. More importantly, the investors have also become more mature. So everybody now has seen, a 10-15 year cycle. And now both the investors and the founders today know how to build more valuable companies faster. You're just seeing the acceleration happen. And that is what is driving this. And my view is that this is going to continue for the next 10-15 years easy. So we are in a very good spot.
Yes, certainly. I mean, in the few opportunities which I have had in like speaking with venture capitalists and private equity, like participants in the country, they've all mentioned the same and said that we are going through this India is going through a very optimistic wave right now. And there has never been a better time to invest, and there has never been a better time to start up.
Yes.
So, I mean, I've like very unanimously been hearing that from entrepreneurs and investors from across various sectors. So it's definitely very affirming when you also mentioned the same. So my next question is on the inflow of foreign direct investment that India has been having, especially again post the pandemic. In around 2021-22, we received around 82 billion of foreign direct investment in India. How do you think that impacts the domestic investors in the country? And how do you think that it impacts the investment or the business community in the country?
So, I think what it firstly does is that whenever there is a company that goes out there and outshouts others on saying, make in India, be Indian, buy Indian, you should first go and look at their cap table. My sense is that a lot of companies which started out in India being Indian, a lot of their investments are actually being done from other countries. I think it's a very healthy scenario. I know that there are these right noises to make, and then there is reality. And the reality is that no country can build an ecosystem which is vibrant and innovative by being in an island. Whether it is companies or whether it is investors or ideas or markets. So it's a very good sign that you have so many investors from outside India wanting to come into the Indian ecosystem to invest. So that's number one. Secondly, how does it impact domestic investors? It doesn't impact in any negative way. It's a very good thing. So if you see us, we would have our breakup of investors into Indian and who are not based out of India. But I think in our case, mostly people will be NRIs. But it's a 70-30 split. And we're very happy with it. We're very happy because what you're basically being able to do is you're being able to increase the pot of organized money that can fuel the growth of farmers. So more money, more organized money, more transparent money is a very good system to ensure that our founders are being able to raise money faster subsequently. So overall, it's a very good scenario. I don't think there is any crowding out of domestic investor, if that's the question.
So, of course, Mumbai Angel has experienced several cycles of early stage investments and has certainly matured in understanding how the economies here play out. Could you maybe give us a sense of how to truly set up a successful investment firm here in India? And what are the metrics that truly measures this success for a VC firm?
Okay. So, Anisha, I would be able to talk about the business of setting up a platform, right? Because we are not a VC in the true sense. Okay, we are a platform. So, so there are two parts to it. One is what makes a successful platform like ours. So I think there are only 2 or 3 things that we as a platform need to ensure that we are the gold standard in investing. The first one is transparency and processes. So our first promise to all our investors who come up is that we will give everybody the same access to deal flow. So why are people coming to us? They are saying that we want to see the best deals that are there with you. So our first promise is, if we get a good deal, everybody gets to participate if they're interested. That I think is absolutely critical. The second is that you need to be able to create a deep enough deal flow that individual investors are not being able to access if they're trying to do it outside. So you need to become a deep enough platform to say, and just to give you a sense of numbers that I'm talking of, we see about 800 companies a month that apply to us for funding. And from there, we, through our, technology, algorithm, our team's expertise, we bring that down to about 10 to 15 companies that we throw open to our investor base of 700 people, and then ask them saying, are you willing to invest in these? So first is transparency processes, equal treatment, the best deal flow that is there. Then the last one is to say, how do you make sure that you're not just doing the deal? Because, and I keep saying this again and again, we are not about investing, we are about exits. Okay, so yeah, and in a social analogy, I can say, I think investing is the honeymoon period, and then the marriage starts, and then there is this 3-4 years of actually, finding out if it works between both parties, right? So we work through that entire process where we are making sure that the investing goes the way where we would ideally want them to, which is saying, A, the capital should be protected for the investor, and then of course there is the upside. So if I look at us, that's the promise that we are making to our investors. To our founders, what is the promise that you need to make? Is to say that we will be able to put you in front of a sizable number of investors who have the ability and the skill to be able to cut checks in your company. So you need to be able to create a deep enough marketplace for what we do, right? So that is one. I think a related question to this is, how does one actually make money in this, and how does one invest in this asset class, right? So, we've been saying this at various points over the last couple of years, is that one needs to start looking at investing in ventures at their earliest stages as an asset class. So what you need to do is that if you have, say, 1 crore of money, you need to say that I'm going to invest about 5 lakhs or 5% of my overall portfolio into early stage venture. That's number one. Second, you need to go with a portfolio approach. So what happens is that, from the outside, this looks extremely glamorous and everybody is out there saying, I'm going to identify the next unicorn. Yeah? And we call that unicorn hunting in our parlance. And we clearly don't recommend it, because I have actually, in my last 12 years, I would have personally seen about 10,000 companies, who have looked at raising money with us. Today, I am much less confident on which of these would work than I was even 5 years ago. So what we need to do is we need to keep investing in larger number of companies so that you build out a sizable portfolio, number one. Secondly, you need to keep investing more in the ones that are doing well. So if there is a company where you've put a certain amount of money and then it raises the next round of money, we always recommend that the investor should invest in that next round and not, take an exit. So don't take an exit till you're actually pushed out. So that is how you make money in this asset class. And like I mentioned, for us as a platform, these are 3-4 things that we say. If you do this well, this asset class has the potential to give you returns anywhere between 25% to 35%. But like I mentioned, you have to do this with patience. You need to know it's a patient capital. You don't need to worry about cycles, and you need to be staying on for the companies that are doing it.
Thank you so much. I think that was some excellent advisory. I'm sure like our viewers would be so excited to hear about these insights and also use them while making their investment strategies for the upcoming portfolio companies. My next question is Mumbai Angels looking at expanding in any specific sectors? Is it looking at investing into any specific sectors in these years? Like as you were just mentioning that we always advise in investing in sectors or companies which are already doing well. So, in your opinion, which are those kind of sectors which are already performing well, and you would like to continue investment in those?
So, see, Anisha, just by our nature, we are a sector agnostic platform, because our job is to keep showing the best deals or best companies that are raising money to our 700 investors. So, what happens is, maybe 20 investors are interested in a certain sector, 20 others are interested in something else, etc. So today, our portfolio actually, so we have a 200 strong portfolio now. It is, I think, spread across some 25, 26 sectors. Okay, so it's all over. There is a split there, of course, which is a deep tech and low tech and no tech. So there is deep tech where, the main business is tech, which is, how actually venture investing started around the world. What we have seen over a period of time is that now we also have a sizable number of companies where their main business is something else, where it is tech enabled. So, a lot of stuff like what would fall over there, ed tech will fall over there, health tech, businesses which are actually doing some other business, but they use technology as a backbone. And then what we also have, what you call no tech or low tech, which is actually consumer. And that is like a very exciting place that we see, is that, we have invested in several companies which are brands. So food brands, beauty brands, like say, for example, Purple is one of our investments, right? So Purple, which is, in cosmetics thing. And then there are several companies which are in food, juices, services. So there is no tech or low tech. There is mid-level tech, and there is deep tech. So that happens. Now, going ahead, what are the sectors that we think are going to do really well and where we see a lot of interest going? And remember, we are at that stage where we catch the trend the earliest, because this is when the founders are raising the money first. So where are we seeing those trends? One, of course, is electric vehicles and, this whole sustainability and the full range of stuff that you do there, from vehicles to batteries to enablers to that whole piece that we do. Then there are 2-3 sectors that I am personally like super excited about. One is space tech. Yeah, so I love space tech. So I think India, we are way behind other countries in investing in space tech ventures. So I'm expecting and hoping that we'll see that uptake very soon. Closely related to space tech is defense tech. So what is a very interesting thing that our viewers should know is that a lot of companies, when they create some of these new technologies that can actually be used both for defense and for space. So we see a lot of interchanging over there. So we are also looking to grow that portfolio. Then there is this whole piece of agri-tech, and you will see a lot more happening over there where, people are going to now figure out how to bring in technology into agriculture in India. Then, of course, there is this overhyped Web3. I think it is a lot of work has happened over there over the last couple of years. But in India, unfortunately, we are not seeing too many newer, innovative ideas that are fundable, that are coming out from there. I'm hoping over the next couple of years, that's something that will get sorted out. But yeah, these are the places that we see a lot of traction happening.
So while shortlisting portfolio companies and of course, while investing in an entrepreneur, what are you looking for? What are you looking at when you're shortlisting those portfolio companies for investment?
So, very interesting question. And I think, you will always hear that there are 2 standard answers to this. Yeah, the founding team and the opportunity. I'm sure everybody says the same thing. I'm going to give, another, of course, those 2 matter. And I'm going to give 2 more perspectives on how we do this and what we are looking for. So one is we've put an algorithm in place, Alisha. So what we have done is that our distilled understanding of the last 15 years of having seen, say, about 10,000 companies, invested in 200 companies, exited 100 companies, and I think some 13 to 15 have died. So it's a full mix. We have tried to incorporate that learning, and we do that continuously. So it's a continuous WIP project that is going on. And whenever somebody applies to us, we try and use that algorithm, which actually uses about 100 different parameters on what is the probability of success of a certain company to make it into a worthwhile investment. Right now, and then there is a scoring, and internally we look at it and stuff like that. Now, apart from the regular stuff, that are, I said, founder, etc., some of the things that we are seeing is actually coming up as very, very critical in making or breaking companies. One is the founding team having complementary skill sets. It's very, very important. So what happens is that nowadays you see that, actually now it has started becoming better because even the ecosystem has matured. But a lot of times you find that, 3 people, good friends or family, spouses, husband, wife, etc., they team together and they start a company. They have not thought on saying, do we have complementary skills or do we have overlapping skills? So typically in any company to succeed, you would actually basically at the base of it, you will require somebody to understand product. What is it that we're trying to sell? Somebody who understands technology, how to build it, and the third one, how to sell it. Sales guy. These 3 things, if they come together in a founding team, we have seen has a higher probability than anybody else to succeed. That's number 1. The second is that are people coming from a related background? So earlier, we used to put a lot of, there was a lot of, romance around Ivy League and IIT-IIM and, engineer, etc. And come, get funded, move. Today, you see that the age of the founder has actually gone into a band where, you will have founders who are 45, 50 and who are getting funded. Why is that happening? Because they come from the domain knowledge. So domain knowledge is now becoming increasingly important because the kind of startups that are now getting built are more complex and they need to scale faster. So that's the other piece. The third piece that we look at is, and I'm talking of a very technical this thing over here, is on what is the capital table looking like, which means that how much skin in the game do the founding team have before they come to us. So what happens is that a lot of times you find that the founding team has actually given off too much equity too soon to investors or passive mentors and people who are not really going to add value to the company. That starts creating a problem the minute you start doing next round of funding. Then is there debt on the table? Are there related parties in the on the cap table? Is the market size that is being addressed large enough? One is to say it's a very good idea. Secondly, can you actually sell it to a large number of people? So these are, I think, like I mentioned, 100 factors, and it is actually something that is evolving. But yeah, these are some of the key things that you would need to look at, apart from just saying founding team and market.
So my final question to you before we close the interview would be, of course, as you mentioned that there has been a flood of venture capital investment, and Mumbai Angels itself has experienced its best years post the pandemic. Of course, we have also seen the kind of technology and digital wave that India has been undergoing post the pandemic. So what is your message for entrepreneurs who are starting out their startups at this point post the pandemic? How do you think that they should be looking at scaling or seeking their early stage investments?
So there's never been a better time to start, Anisha. What founders need to do now, though, is that they need to be more prepared before they come in front of the investors. That the founder has to do. So a lot more homework is required today just because the ecosystem has matured. So, for example, today, if a founder is putting something together, don't just go out there and write a program because you think it's a good idea, or don't just create something because you think. Today, you thankfully have players at all levels of the ecosystem. So you have accelerators, incubators who are willing to listen to you even when you are just a concept company. So do that rounds, go out there. Don't just, we've seen, so there are two types of founders. One who have built companies several times over. So then they know that it's easier and quicker to cross some of these hoops. For first-time founders, it is very, very important to do some of these rounds with some of the accelerators and incubators. Not to us. So don't waste time with a platform like Mumbai Angels if you're just starting out. Better to first, cut and sharpen your idea, sitting with some of the incubators, accelerators, from angel investors from your domain. Very critical. So if you are, say, for example, trying to start something in the F&B space, just do a market research and just try and reach out and talk to some people in the F&B space. Maybe earlier found. And another way to do this is, entrepreneurs who actually build businesses in the same space. So do that market research, try and understand what's going on. Then jump into trying to look for money. Because I think now it's gone reverse, we get so many emails where people we have this fabulous idea and we want this money to start. It doesn't work like that. You have to do the other way. And once you have built the prototype, okay, that is when trying to raise the next level of money has become increasingly easy in the market. Having said that, I want to just end this by saying that just because raising money has become easier, the hard work of building a company from ground up has not become easier. So, that's the one thing that founders need to understand, is that the hard work of building the company from ground up still remains the same. It's just that now you will have money faster than you did before.
Thank you so much, Nandini, for your time today and for sharing such insightful answers. I'm very sure that our viewers are going to be so engaged and they'll be so thrilled to know so many information and so many knowledge base, which will definitely add to their strategy while scaling up their investment strategies or their companies. So thank you so much for joining us today. And we look forward to having you again with Business World.
Thank you.
Thank you so much.